Hello guys and welcome back to the channel. Today we're gonna make a video that I promised you for a while, because many of you are asking me what kind of strategy I am using to invest with, how I find the stocks that I choose. And today we're gonna start a series of small building blocks where I slowly but surely are teaching you 100% exactly how I invest. And as you can see, today is part 1 and we are talking about something called relative strength. Basically, what I do when I invest is that I am a trend follower, meaning that I buy stocks that are in an uptrend. I never try to bottom fish. I never try to speculate as to when has this stock fallen enough. I never listen to the news. I never read posts on Facebook telling me that this or that stock should go up in the near future. I have a 100% rules-based strategy. That means that I can backtest my strategy and that it is easy to go back on the charts maybe 5 or 10 years and look at the setup, and I can say with 100% certainty if I would have bought a stock or not. So today is the first part and we are going to talk about relative strength. First of all, we're going to talk about momentum. And you might know this guy here. This guy is Isaac Newton, one of the brightest heads ever in the history of science. And the reason why I have picked a picture of him is that he had this law of motion. Not that I am a specialist in that, but basically what that law says is that when an object is put into motion, it will keep in the same direction until it meets a force that stops it. And that is pretty much what I am doing when I am investing. One of the stocks we're going to have a look at today is, for instance, Microsoft. And what a trend follower does is that he or she finds a trend, and it could be a trend in Microsoft here, a price trend. And let's say that we were clever enough to buy down here when the stock was down in $52 or $53. Then a good trend follower would stay with this trend all the way up and never exit the trade, or not until the trend breaks. So a trend follower or a momentum trader is one that goes with stocks that are already in some sort of a trend. That means that I personally never get in at the bottom. I never get in right at the bottom somewhere where that is a Microsoft. I always get in a bit late. And when the stock starts to turn down up here, I never get out right at the top. It always has to break a trend, and I always lose maybe 10 or 15% at the top here, but that's just the price of being a trend follower. So I have been doing this for a great number of years, and I have been beating the market most years with these simple strategies. So let's have a look at what momentum investing actually gives, what kind of results we can get. There's a lot of statistics that shows that momentum trading is a good way of trading. It just takes some patience, and because sometimes the market is just against it. So sometimes you can go 1 or 2 years where the results are not perfect, but seen over 10 or 20 years of investing, momentum trading or momentum investing is quite good. I have picked some statistics here. For instance, here is a statistics made from 2003 to 2019 in the US stock market, where the stocks that were picked was the one that had done the best over the last 6 months. And that can be a bit counterintuitive, because most people, when they see a stock like this, like Microsoft, they would say, well, I think it's a bit too late to get into Microsoft because it has already run very far up. Well, let's say, for instance, that you could have started here at 40, but at some point it had gone up by 100% here. Let's say that some sort of momentum strategy told you to buy the stock here, and you said, well, I think it is already up 100%, so I'm not sure I want to buy it. If you had said that, you would have missed the next 140%. So if you follow the rules of momentum-based investing, you never get in at the bottom. You get in at in stocks that are already gone up quite a lot. And what we can see here is that if you choose the 50 stocks with the highest momentum, and this is over, I know 16 years is not an eternity, but still 16 years. And this is over, we also crossed 2008 here, where we had the big financial crisis. And what we can see here is that picking the 50 stocks with the highest 6-month momentum, meaning the 50 stocks that had gone up the most over the last 6 months, well, over these 16 years, that would have returned 12% per year. If you would have chosen the 50 stocks with the lowest momentum that had gone up the least, you would only have made 4.9% per year. As we can see here, and as you already saw in the video about the interest part, the compound interest, these percentages can actually stack up to be quite a bit. So the cumulative returns here, buying the high momentum stock, was 567% over 16 years and only 121% with the low momentum. And we can take a lot of numbers out here. You can see there was a drawdown at 62%, and that was probably in 2008. We can also see here where if we had chosen the US large cap momentum, and this is split up, so we have low momentum, that is the 20% of the stocks with the lowest momentum. Here is the 20% with the next lowest, and the mid stocks, the next highest momentum stock, and the high momentum stocks. And here it is split up in decades. So what you can see here is that from 1943 to 1952, the low momentum stock went up 9.7% per year over a 10-year period. If you had chosen the high momentum stock, they would have gone up 21.3% per year, meaning that you would have made a difference of extra 11.5% per year over these 10 years. And you can see for every decade here, we are beating the market. There was a 10-year, a decade here, where it only did beat the market with about 1%. But overall, from 1943 to 2012, you can see that high momentum stock would have given you 15.1% per year, as where the low momentum only gave you 4.5%. And we could go on and go on with these statistics. They all show that if you buy stocks that are already going up, there is a tendency for you to make money. So let's go to the graph and see how I look at this, because there is a little extra detail. Let's say, for instance, that I asked you if you would be satisfied by making 20% per year in a given stock trading year. Most people would say, yes, 20% in a year, that is great. Now, what if I told you afterwards that the overall stock market in the same year had gone up with 40%? Would you still be satisfied with 20? Well, most people would say no, not if the risk were the same anyway. So what we really want to see when we are looking at momentum is not just stocks that are going up. We want to see stocks that are going up faster than the overall market. So what we're going to look at here is we're going to look at Microsoft, but we're going to look at an indicator I have down here. An indicator, when we're looking at stock charts, if you're not familiar with stock charts, an indicator is some sort of mathematical graph. It basically just takes the price and time and then puts it in some sorts of algorithm, some sorts of calculation, and shows it in a visual basis. Just remember that this is an indicator, and what an indicator does is that it indicates. It is never a sure thing. It's never a holy grail. There is no indicator in the world that can 100% certain tell you now this is a buy, this is a sell, and you will make money every single time. It is something that you can use to lean against and say, yes, now this indicates that what I look at in the stock chart is a buy or a sell. So we have here Microsoft, and Microsoft, I think we can all see that it is in an uptrend. But now the Microsoft trend is going up like this. Now, what if the overall market actually went up like this? Would we then be satisfied with owning Microsoft only going up 10 or 20% per year if the overall market were going up with 40? No, I guess we wouldn't. So what we have down here is a special indicator, or special, there's nothing magical about it. It is called CRS, or comparative relative strength. When we're talking about relative strength, there are two similar topics here. A lot of investors and traders know an indicator called RSI. That is called relative strength indicator. That is not what we are talking about here. The RSI is something that can be used for a lot of things. Some people use it to tell if a stock is overbought or oversold, or it can be used for all sorts of purposes. But what we are talking about here is something called CRS, comparative relative strength. So what this one does, and what we need to look at here first, is this thin gray line, because that is our relative strength line. What it does is that it takes the price of Microsoft or any given stock, and then it compares it. In this instance, it compares it to the SPY, meaning the S&P 500 index. So what this actually tells us is that when the gray line is going up, it means that Microsoft is going up faster than the overall market. Here we can see, for instance, the price went down. But at the same time, let's just make it a bit larger here so we can all see it. Here you can see that the stock was actually going down, and it lost something like 18% here in in the end of 2018. But what you can see is that the relative strength line is actually pretty much going sideways. And that means if you were in the market in the autumn 2018, in the fourth quarter, you know that the stock market went down. So what we can see here is actually that this stock is going down, but the relative strength is keeping at a level. That means that Microsoft is falling at the same pace as the overall market. And we went a bit down, but then Microsoft started going up, and you could see here that the relative strength line started to go up as well. That means that this rise in price were faster than the rise in S&P 500. I hope it is not too confusing, but what it actually tells us is that we have a car here, and we have a car called S&P 500, and this one is just telling us which one of them is winning. If this one is going up, our car here, Microsoft car, is winning. If this one is going down, let's see if we can find a time where that happened. Let's see here. Here we can see a time where the stock actually went sideways. Most people would say, well, this is not too bad. It's not going anywhere, but it's not dropping. No. But here we could see that the relative strength line were dropping, meaning that at the same time, S&P 500 must have gone up. So sitting with Microsoft stocks here, I'm not saying that it should be sold here. There are a lot of other things in this to consider here. But what I'm saying is that just because the stock is going sideways, it can actually be a bad investment, because you could have been in something else that was going up faster. So the first little piece of the puzzle here in my investment strategy is that I can only consider to buy a stock when I can see that the relative strength line is going up. There's also two other lines here. There is the thin red line and this blue line. That is what is called two moving averages. And normally up here you can see two lines as well, and this is two moving averages on the price, meaning that at a certain point here we have a blue line saying, let's say this is the 30-week moving average. So at this exact moment in time, the indicator here tells us that the out here that the moving average was at $123. That means that the average price over the last 30 weeks have been $123.41. So many people use these moving averages to say if a stock is trending or not, and we can do that. I have a couple of other tools to do that, but what we can see down here is that we have two moving averages, but that is not moving averages on the price. It is moving averages on the relative strength. So when the relative strength is above both lines, we are having a stock that is really running a lot faster than the overall market. Then we can see that it drops below the red line here, and that is a 20 period moving average here. It drops below here, and that gives us a little warning, and it tells us, hey, now you need to look extra carefully here, because now we have a stock that is not running as fast as it used to do. It is actually losing momentum compared to the overall market. But it didn't breach the lower one here, so everything was good, and the moving averages up here held as well, and we started to go up, and the relative strength moved above the red line again, so everything was good. We stayed in the stock, and it was a good investment. But let's have a look at another, because this is a trending stock, and that is always easy to find, and every indicator can look good at a trending stock. But what about Facebook here? That is a bit more messy. Not that Facebook hasn't been a good stock to own. We can see here, again, compared with the S&P 500, we can see, let's say, for instance, we got a look at Facebook here at around 80. And we can see at some point here, the relative strength went above both its moving averages here. And we could say, I want to buy it here at 87. Now, when would we have exited if this was the only thing we were looking at? Well, up here, it started to breach the red line first and then the blue line. So we might have gotten out here at 117. That was a good profit, and nobody knew at this point if Facebook were going massively down or up. You have to remember that all we could see here at this point was just about this. So we could see that it started to breach these lines, and maybe we would have sold here around 117. But we can follow it here, and we could see that it went up again here. Now it is above both its line, and we could buy it at 131 approximately. And you can see that it went up, 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 up. Then we started to get some worry signs down here that it was breaching one of the moving averages here. As I said before, this is not the only thing I use to look at a stock, but somewhere around here, I'm pretty sure I would have sold, because I would have gone out around 160. And you could say, well, that was a kind of stupid, because then the stock went up again, and you missed all of this rise in price. And yes, that is one of the prices you pay using this indicator. Sometimes you're getting tricked out. So here you might have gotten in again in 187, and then you were shot out at 175. And you can see that here we can actually take some losses. And now remember, we are only looking at one piece of the puzzle. I have a lot of pieces that I use, but this is one of the main pieces I use. This is one of the most important things that you need to remember. If you have questions about it, please write it in the comment section below, and I'll do my best to answer it. We can see here the price goes down, and we are going out here at 176, and then we are kept out all the way down to 125, something down here, and then the price starts to go up, and we might go in here again in 175, and then we are kept in up until now. We wouldn't have exited at this point. So here we have a bit more messy, choppy stock, and choppy markets, sideways choppy markets, are the worst kind of markets for strategies like mine. That is where I lose money, and I do lose money from time to time, and that is always in choppy markets. Because if the market really crashes, I get out of all the stocks in good time and I don't take the entire loss, and then I don't get right in at the bottom. Let's have a look at another stock where I can show you how effective this is. General Electric. Now let's just remove this big channel we have on here. Now General Electric, many people were surprised that it would drop so much, and it was one of the big dividend stocks and one of the big industrial stocks in the US. And a lot of people said they would never have guessed that it would drop from 28 and down to 6 or 7. But you know what? Our relative strength indicator here showed it to us. It started to give us sell signals here back in 2016, where it started to underperform the market. Well, I didn't know that it was going to drop a lot in price, but I knew that when this one, the relative strength line, when that starts to drop, it tells me that the entire market is going up faster than this stock. And I don't want to be caught in stocks that are going sideways or is dropping for years. I want to have my money in stocks that keeps going up. So when this scenario starts to happen, I wouldn't have sold right away. I would probably have looked, as I have drawn in here, I would probably have drawn some sort of support line and said, well, when that is broken, I'm getting out. So I would have gotten out here around 24, when this one for a long time had shown us this is underperforming the market. And then the rest is history, as they say. We would actually have been sold out here, exited from the stock around 24. That would have been in May 2017. Now we are talking about the beginning. We are in the beginning of 2020 right now, the 9th of January. And at this point in time, we would have been out of the stock for the last 2.5 years. Now, GE is actually starting to come back. And if this was the only indicator we were using, we would actually had entered the stock again here around 11 approximately. And there's something that starts to show strength here, and maybe it is going up. We can take up General Electric again in one of the next videos where I am giving you more pieces to the puzzle here. But this is just to show you that all of the stocks that have huge drops in price, I'm getting out of in very good time. I can give you another example. Yes, here I just found the Goldman Sachs group, and I went back to 2008. And I know, well, you say 2008, isn't that a bit easy because everything was dropping? Yes, well, something was dropping more than other. Because what you can see here is that we would have been in Goldman Sachs all the way up here, up until mid-2007. Then we got some sell signal here around 165. We might have got triggered into the stock again here around 195 and had taken a bit of a loss here of maybe 10 or 15%. But we missed this entire drop down to, it turned down in 38 in November 2008. If you remember that, if you were in the market at that time, that was really, truly devastating times. And everybody thought that the entire financial system was going down the shore. But what we could see here is that around here in February, when everybody thought the entire market is going down, Goldman Sachs actually started to outperform the market. And what happened there was, as you can see here, we never get in at the bottom. So we didn't get in at around 40. We might have gotten in around 80. But then we had a sell signal all the way, a buy signal that went all the way up down here to 140. So we made almost 100%. Then the stock started to go sideways, and we would not have been in it because it was underperforming the market. It was not that it was dropping massively here at the beginning, but it was not doing as well as the overall market. And as you can see, we would have gone out around 140, 50, maybe 160 up here, and then we would have been kept out of the market for what? 2.5 years, where our money would have been sitting doing absolutely nothing in a dropping stock. And then we came in again here at 108. We could have gone out somewhere up around here, maybe at 140 with a nice profit. And then it got a bit choppy. We might have gotten in and taken a little loss. But then again, you can see we are getting out of the stock here around 167. And we are missing, if you can say so, we are not having our money sitting in a sideways going stock for an entire year. Imagine having $100,000 sitting in Goldman Sachs stocks in this year, where it could have gone out making money in other stocks this year, but here you were making absolutely zero. But here in October 16, we got a signal that now it is outperforming the market. And as you can see, it came up. We might have gotten out here. We might have gotten out up here somewhere. That would have been some of our other indicators and other things that I'm looking for in the market that would tell us where to get out. But up here, around 235, we would have been sold out of this stock. And we would pretty much have been out of the stock up until now. So again, our money would not have been sitting in a sideways stock or a losing stock for a year and a half. So this is what the relative strength indicate. No, sorry, not the relative strength, but the comparative relative strength tells us. It tells us how is the stock doing compared to the stock market. And this indicator, as I said, this could be the SPY, but maybe you had some sort of idea that you could you wanted to compare it to gold instead. So you would somehow buy stocks that were doing better than gold or whatever. I've never tried doing that with gold, but that was just to show that you can choose whatever instrument here. You can choose oil futures. You can choose another stock. Maybe you would say, well, the Barclays Bank. This is an ETF, but we have here the English Barclays Bank. I want to buy Goldman Sachs when it is doing better than the other banks, for instance. You can use this indicator to compare a stock to pretty much anything as long as it has some sort of a ticker code. Okay, so what you can do now is that beneath this video, if you want to have this indicator, or at least this version of it, you need to have Tradingview as a platform to analyze stock with. And there's a link to the Tradingview down here below. That is an affiliate link. Not that you have to pay anything for the Tradingview. It is a free piece of software, but they also have a paid version. So if at some point you should choose the paid version, they know that you have downloaded through me, and well, then I get a little cut of the price there. So, but you can also go in on tradingview.com to find it. So you have to use the Tradingview and start a user up there, and then you use this indicator, or you need this indicator. Normally in Tradingview there is a ton of indicators up here. Where you can choose a million different strategies. But what you need to do is you need to get in on the link I'm putting in below here. And this link will send you to a site where this indicator is, and you have to press a favorite button in there. And when you press that, and next time you go into Tradingview, you go into favorite, then you will have the indicator in here in your favorites, or maybe under my scripts it might also be there. But if there are any problems, just write me and I'll help you find it in the right way. But as soon as you have it in here in your favorites, you can just say, I would like this one, just push it, and it will push the indicator in here, as I do, for instance here, a rune oscillator. As soon as I push this one, you can see I'm getting a new indicator down here. So that is how you get it. And as I said, if there are any problems, just write me and I'll help you get it. Alright, that's all for now. This was just one piece of the puzzle. I am gonna make a series of videos, as I mentioned, of 10 or 15 videos telling you exactly how I pick my stocks. So this is the first part. Get Tradingview, get the indicator, and start playing around with it and see if you can make it work. Alright, if you haven't done it already, please subscribe to my channel, like this video, and if you have some questions, write it in the comments below. All of that will show YouTube that this is something you like to see, and you will be shown my stuff every time I put up a new video. Alright, that's all for now. Take care of your money out there. I hope this was an inspiration. Talk to you soon. Bye.